Good afternoon. This is a follow-up for the information that was previously posted on YouTube about the options related to ticker symbol PBR, that is Petrobras, the Brazilian oil company. As I was explaining in the previous video, the technical pattern that I look for and that I've been teaching for many, many years appeared on this particular ticker symbol with extreme clarity. That picture that I'm looking for is the price pattern, which is this top part of the chart. I want it to hit a low one time, then I want it to move up and subsequently come back down and retest that same price level again, or even go lower than it was previously, which would even be better, provided that the technical pattern, and this is a daily chart, by the way, so it's a relatively high time frame with an ability to give duration to the move rather than just a quick 5-10 minute day trade kind of thing like that. It could give rise to a good day trade because of the technical strength that exists here, but that is not the intent of this pattern. The intent of this pattern is by design supposed to make the price move for a longer period of time and be more powerful than a real-time chart, which would be any chart underneath the daily chart. That would be 60-minute, 30-minute, 15-minute, 5-minute, and 1-minute charts. So that would be what you'd be watching during the course of any given day. But provided the daily chart had the picture as it did in this example, which is almost exactly the kind of picture that I look for, meaning the price had hit the same low or lower than it was the original time when the indicator hit its low. Now, the technical low was much higher than it was previously, and then provided that the lower time frames, that would be these real-time charts, the faster moving of the two lines on the MACD indicator, in this case the blue line, same thing under each one of these, when they turn in the direction of the divergence meaning difference between the indicator bottom and price bottoms, this indicator bottom being sharply higher than the original low of that indicator, but the price is exactly the same or even slightly lower. And if you believe the indicator that it's pushing up on the price, see, that would be up, up, up. That would be this amount of force like this pushing up on the price, meaning that it wants it to go up here somewhere. So if that's the case, and I'm interested in using options to leverage what I see here, then I need the lower time frame indicator to turn in the direction of this divergent picture. So this divergence has enough strength to push the price from the level that it was actually trading at, around $6. It had enough strength to push it up to, it looks like, around 8. But that is just an amount of pressure. It doesn't have to designate exactly that price range or anything like that. It's just an amount of pressure against the price. So is it significant or not? Is it significant enough to justify trading out of the money options? This particular picture that we see here was back on the 6th of January, the first divergence, and then the price moved up from that point on up to where the technical top stopped on this chart when it started to falter, and that was around the 26th of January, and the price had moved up to $7.36. So if you look at the time frames underlying it, you may be able to see the clarity a little better, since it's these lower time frames that feed the move of the higher time frame divergence. We want this blue line to turn up in the direction of the divergence. It started moving up here. So anytime in this particular period of time right here, the technicals are moving up and there's a divergence on the daily chart. So it would have been a great time to have bought these out of the money call options. And this was on the 6th of January. And like I say, the technical pattern is something that gives rise to something a little bit longer term than just something that's going to last for a day or two. But the greatest opportunity comes when this time frame underneath it turns up. This blue line turns up in the direction of that daily divergence. And then if you follow it until it loses its strong momentum, which would be over here in this range, see, right over here, right in that particular time frame right over here, that'd be, so when it starts to lose its momentum, it's on the 8th of the month. So generally the greatest move on things take place at the very beginning, just like pulling a rock back in a slingshot. When you first let go of it, the greatest momentum is at the beginning, and eventually gravity takes over and pulls it back down to earth. It has a certain velocity and strength at the very beginning stages, and that's the same way it is with these stock prices and things like that. And I'll just give you an example. These are options that expired here on the 6th, which was this past Friday. If I go back, back to the January calls to give you an example of how you could have taken advantage of the January calls, and I'll get back to this one in a second. January 3rd Friday options. So it was just as an example, designed to last a little bit longer because of the daily divergence. January 3rd Friday, which is actually Saturdays on the 3rd Friday options. So the expiration date would be January the 17th. So when I look at this, it's the year. This is Thinkorswim, by the way. This is TD Ameritrade's platform for options and charting and things like this. Very nice charting platform. If you want to look at something like this, then you could get that program, TD Ameritrade, or have an account with them. You could use a program like this. Very nice. But anyway, this is the year 15 and then 01 and then 17 and then call option. And like I said, the price was somewhere below 6. So the 6.5 call or something like that would have been something worthy of attention. Generally, I'm looking for options that trade for under 10 cents. So that would have not qualified for that because these were 12 cents. It's not that it was a bad trade on the 6th. Remember the day that it started to move. And then by the 9th here, remember these are 3rd Friday options, and not the ones that expired just in a few days or something like that. But these are options that expire 3rd Friday of the month. But by the 9th of the month, which would have been just a few trading days later, the options that were 12 cents, you could see that they were 78 cents. So that's a pretty decent return. But I'm only interested in options that trade for under 10 cents because I want a little bit better leverage if I can possibly get it. To go back to the 6th of the month on this, those are trading for 7 cents, and they moved up to 45 cents. They're about 40 to 45 cents. So that's I don't know, 6 or 7 times your money there. And so you can see that it's not asking too much to buy options that are trading for under a dime. And that's just one example of the possibility to take advantage of something like that. However, that move took place in just the first 2 days. And if you look at something like Petrobras, it has options that expire every week, weekly options. So you didn't have to buy third Friday options. You could have bought the options that would have expired just a couple of days later on the 9th of January. So instead of this being the 17th over here, I could have made this the 9th, and maybe instead of the $7 strike price, the 6.5 calls were trading for under 10 cents on the 6th. Let's just see. And here is the 6th. You can see those were trading for 3 cents, and by the 9th, they were trading for 66 cents. That is 22 times your money, 2,100%. So you see, the greatest return on the options comes from the very beginning stages of the move. So there's no need to buy options that are further out. Time is not your friend. The chart pattern is your friend. And the chart pattern, no matter how well it's wound up on a higher time frame, such as the daily, it still moves and then stalls relatively quickly on the time frames below it. But this took a couple of days before it stalled, and therefore the opportunity was really, really good, just right there in the very beginning stages of that move. You can see that 20 times your money. Had you invested $1,000 in less than 2 days, you would have had $20,000 or thereabouts, or whatever it is. By the 8th, those options already moved up to 41 cents. So that was from 3 cents to 41 cents or 42 cents. It's about 14 times your money or thereabouts. So $1,000 to about 14,000. And so that's a pretty good return. And then it moved on back up the next day after, wavering around a little bit for some period of time one day, and then moved back on up. The technical strength on the chart still existed. It just stalled just a little bit right here, and then regained that composure and moved right on back up to a higher high. And then that was the end of that particular thing. Later on, as the price once again on the daily chart retested the same lows, which once again, I don't care how many times the price retests the same lows. It could be 25 times in a row. But in this case, this is the third time that it retested the exact same price levels. But you can see that the technical bottoms that we just looked at on this one, we saw that made 22 times your money on this little move right here, just from right here to right there. Just that little microscopic move in the options was 22 times your money. You look at a chart like this, if you're a novice, and you can't believe it. You say, this can't be right. But I can assure you it is right. It's just the nature of out-of-the-money options trading. You've got high leverage, and it's also the nature of looking at a pattern divergence, because this is the underlying foundation of the price. It tells the price what it needs to do. So when you build up this technical pressure underneath the price, and you keep building it, and then you release it by the lower time frames turning in the direction of the divergence, then the moves are very, very extreme. So this last time, this was just on the 30th of January, which was essentially a little over a week ago. So the stock price was back under $6 yet again. And same thing. We'd be interested in the options, probably that expired, in the sense that was an expiration day on the 30th there. Then I would have been interested in the options that expired just this past week, to be able to take advantage of that near-term jolt of energy out of the divergent picture that exists on the daily chart, because that's where the greatest momentum lies, is in that initial stage of the release of the momentum. So That generally lasts for a couple of days or something like that, and that's fine. So we would be interested once again in the $6 calls or 6.5 or $7 calls, the ones that traded for under 10 cents a share. Now I'm going to put this back to the excuse me, go back to 206 6.5. And on the 30th of January, let's see if we can take a look here. 30th of January, be back over here. The price of those options looks like on the 6.5 calls were about 8 cents. And it stayed right there in that range even through the next day or so of trading, which would have been following Monday. It was still sitting there because these are out of the money options. Remember, the price was below 6, and these are 6.5 calls giving you the right to buy the stock for $6.50. Well, you could just outright buy it for $5.80. Why would you buy an option and give you the right to buy it for 6.5? Why? Because the leverage factor. Because essentially you have the ability to control the price for 8 cents a share rather than paying $6. That's why. So the leverage would be that factor of 8 cents versus $6. How many 8 cents are there in $1? About 12, 12 and a half times 6. And that's your leverage. So you're talking about 75, 80 to 1 leverage factor here, see? So that essentially means for every dollar you invested in the stock price versus the options, $1 in the options would make you $80, and the dollar in the stock investment would have only made you $1. So it's 80 to 1 return, basically, and that's about how this works out. If you look at the options, they move from that 8 cent level up to 95 cents. So that's well over 1,000%. See, and that's the 6.5 calls. And there's also the 7 calls. And those, you see, back on the 2nd and everything, and even on the 30th and everything, those were trading for about 3 cents. And those went to 53 cents before it stalled on the 4th, which was a couple of days ago. So from that 3 cents to 53 cents, you're talking about, 20 times your money would be 60 cents, right? So it's a little bit less than 20 times your money. Again, so that's 2 different times, both with the quality divergences that I look for on the daily chart, and each one of them produced returns in excess of 1,500 to 2,000%. Both times, both with the exact features that I'm looking for on the pattern, and then the release of that pressure by the lower time frame. The only reason why the second one did not make as great a return as the first one is because it was further away from expiration day. This would have been on a Monday. The other one was on a Wednesday, I believe, that you would have taken advantage of the first move, or Tuesday on it. So the closer you are to expiration, the less time value there is in the option premium, and gives you a greater ability to leverage your money. But anyway, if your math is anything like my math, just a $1,000 investment the first time would have turned into $22,000 on this stock or the options. And then the very same pattern set up for the third time and produced another, what is it, from 3 cents to 54 cents. Let's see, that's about 18 times your money. So $1,000 invested again would have been another 18,000. So between the two trades, you would have made $40,000, and the only thing you invested was $1,000. So your risk was really zero. Why? Because you're looking for a particular type of pattern. You're not just willy-nilly throwing money at something and gambling, taking a chance that it's going to move a certain way. It's the underlying technical foundation and the amount of pressure against the price, and then the release of that pressure by the time frames that underlie it. And that combination of factors is the thing that leads to this intense return and fantastic opportunity to trade and leverage your money and to greatly enhance any portfolio with extreme confidence. This kind of picture occurs quite frequently. This is just one example on one stock. However, on the major index options, such as the Standard & Poor's 500 and the volatility index, this occurrence like this is even more frequent. You may be shaking your head in disbelief, but in the next few videos, I'm going to show examples of the Standard & Poor's 500 index and the volatility index and how the returns on those were even greater than this.